All right. Well, Evercore ISI bracing for further market weakness. Julian Emanuel is the firm's senior managing director. He joins us here on set. Julian, great to see you.
Great
How
to be
much
here.
more weakness are you thinking of?
Probably not a lot more.
Okay.
So we came in essentially December the 18th, the FOMC changed the outlook on how to think about volatility. And we finally get this idea where, yes, there's damage being done by virtue of higher yields. And yes, at what was then 25 times trailing earnings, markets are going to be vulnerable to less than perfect news. And we've had a lot of less than perfect news over the last several weeks. But when we think of the manic swings in sentiment we've seen in just, frankly, since the beginning of the year, and you superimpose that on the fact that earnings season is starting Wednesday, you're going to get a CPI report on Wednesday, and you're going to get a new president inaugurated on Monday, even if some of the information there is less than perfect for markets, you're going to have resolution of uncertainty to a certain degree. So to us, we think you possibly test 5,700 on the downside. If things get, incrementally more ugly, maybe down to 5,520. But for us, the bigger picture is we think you're going to 6,800 by the end of the year.
So thanks for being here. So if you were to get to that 6,800, what do you think what makes up that perfect environment in terms of unemployment, inflation, financial conditions? What's the perfect brew there?
The most important thing is that the 10-year yield remains in check.
What's check?
Okay, check is basically, call it 450. You could nudge towards 5%. But frankly, if you look at the entirety of this bull market going back to October of 2022, stocks have had difficulty, as they are now, when you get above 475, and you've actually only spent one day at 5% in that entire time, and that was the end of the biggest correction that we've had this entire cycle. So to us, that is the thing, because the Fed, I don't care what anyone says, the Fed's not hiking rates this year. Let's put that aside. And we don't think there's a recession. But what you're left is how effective the bond vigilantes are going to be in dictating what the limits of policy and dictating where multiples can go.
Are you worried at all, though, about inflation as it relates to, look at copper prices going higher here. Look at oil prices going higher. I realize there's been fundamental news around the oil market. I don't think so much around copper. What we're seeing feed through here, look, a lot of people have. The Fed funds rate means nothing to what they pay for their mortgage, for their houses, corporate borrowing. I think inflation is going higher. And I think leaving the Fed aside, how does that play into the equity market?
So, look, over the long term, inflation in manageable dollops tends to be a positive for equities. We know that's one of the rationales. I think you have to think about it within the context of what the intent is this year. And when you look at the Fed, they're likely going to tolerate inflation being a little bit stickier the same way they did last year in the spring, simply because their read right now is that the longer-term 10-year yield moving up the way it has is likely going to moderate financial conditions from overheating.
After being inverted for the longest time in history, the yield curve is now as steep as it's been probably in 4 or 5 years-ish. Good or bad?
At net, good. Okay, I think this entire cycle, going back to post-pandemic, the return of quote unquote normal price of money and normal term premiums, we both know that in our careers, this is still very low in terms of where the yield curve is, and you could go a lot higher. Our concern is that it happens in a more disorderly way if there's a reaction to policy as it evolves over the next several months, but we don't expect that as our base case.